Today we are taking a closer look at the movie Sisu Road to Revenge. In this video, we will talk about the film in detail but not in a scene by scene way. We will explore the overall concept of the movie and what makes it stand out as an action experience. We will also discuss the performance of the cast and how conveniently the characters are portrayed. Along with that, we will touch on the movie box office impact and audience response. This is more of a thoughtful discussion and review so you can understand the film on a deeper level before forming your own opinion. The production budget of Sisu Road to Revenge can be examined as a practical indicator of the film's scale, ambition, and intended market position. Reported to the approximately $12 million, the budget placed the film in the mid-range category for modern action production, particularly those operating outside the traditional Hollywood studio system. This level of funding suggests a deliberate balance between creative ambition and financial restraint rather than an attempt to compete directly with large-scale blockbuster release. When compared to the original Sisu film, the sequel's budget represents a noticeable release. The first film was produced on a significantly smaller budget, which reflected more contained scope and limited international exposure at the time. The expanded budget for Sisu Road to Revenge indicate a response to the first film's success and its ability to attract a wider global audience. This increase likely allowed the filmmaker to enhance production values while still maintaining cost discipline. A budget of this size typically cover a range of essential production elements. These include cast, salaries, crew wages, location expenses, equipment rental, set construction, costume design, practical effect, and post-production work such as editing, sound design, and music composition. Giving the film's genre a meaningful portion of the budget would have been allocated to action, choreography, stunt coordination, and safety measures, all of which tend to raise cost even when visual effects are kept to a minimum. The financing structure behind Sisu Road to Revenge reflect a common model for internationally oriented genre films rather than relying entirely on a single major studio. The production combined private investment with institutional support. This approach reduces financial risk by spreading cost across multiple stakeholders while also preserving a degree of creative control for the filmmaker. Government backed film funding, though only a fraction of the total budget, likely play a supportive role enabling the project to move forward at its intended scale. From a commercial standpoint, the production budget serves as a baseline for evaluating financial performance. In general, a film must earn back its production costs through a combination of theoretical revenue and post-theoretical income before profitability can be accessed. While box office performance is the most visible metric, it is only one part of the equation for films like Sisu Road to Revenge. Additional revenue streams such as streaming license, video on demand scale, and international distribution deal often play a substantial role in offsetting production expenses. It is also important to consider how this budget compares to broader industry standard. Contemporary studio action films frequently exceed production cost of $50 million or more, with some reaching several $100 million. In contrast, Sisu Road to Revenge operate on a fair, more controlled scale. This suggests a production strategy focused on efficiency, practical filmmaking technique, and targeted audience appeal rather than mass market spectacle. Overall, the production budget of Sisu Road to Revenge reflect a calculated investment rather than excess spending. It allowed the filmmaker to expand upon the original film's foundation while remaining within realistic financial limit. As a result, the budget itself became a useful lens through which to understand the film positioning within the action. A result, the budget itself become a useful lens through which to understand the film positioning with the action genre, ambitious enough to feel substantial but restrained enough to manage risk in a competitive global market. The domestic box office earning of Sisu Road to Revenge reflect the realities of contemporary independent genre filmmaking rather than the expectation placed on mainstream or studio release. In the United States and Canada, the film earned a modest theatrical gross reported in the low single digit millions of dollars during its domestic run. While this figure may appear limited when viewed through the lens of blockbuster cinema, it carries a different significance when evaluated within the independent film ecosystem. To understand what these numbers mean, it is important to first clarify what domestic box office represent. Domestic earning account only for ticket scale in the US and Canadian market and exclude international revenue streaming details deals, physical media scale and licensing agreements. For independent films, especially those originating outside the US, domestic box office performance is only one component of a much broader financial picture. In the case of Sisu Road to Revenge, the film was released in a limited to mid-wide theatrical pattern rather than a full nationwide rollout. This type of release strategy is typical for independent action film that target a specific audience rather than general movie-going public. Limited release naturally cap box office potential as the film is shown in fewer theaters, often for shorter engagement period and with less marketing exposure than studio backed titles. Marketing scale play a significant role in shaping domestic earning. Unlike major studio film that benefit from tens of millions of dollars in advertising and promotional campaigns, Sisu Road to Revenge rely on restrained marketing effort. Promotion focused largely on digital platform, genre media coverage, and word of mouth within action film and cult cinema communities. This approach limit immediate box office impact but help control cost, which is critical for financial sustainability at the independent level. When placed alongside similar independent action film, the domestic earning of Sisu Road to Revenge fall within an expected range. Many internationally produced genre films struggle to cross even a few $1 million domestically unless they feature high profile stars or strong franchise recognition. For such film, theatrical release often functions less as a primary revenue generator and more as a visibility tool that enhances downstream value. Another important factor is audience targeting. Sisu Road to Revenge appeal to a niche audience interested in stylized, violent, minimalistic action cinema. This type of film does not aim for four-quadrant appeal, nor does it attempt to attract casual moviegoers. As a result, domestic box office number reflect depth of engagement rather than mass attendance. The people who attend are highly motivated viewers, not incidental ticket buyers. From an industry perspective, modest domestic earnings do not automatically indicate underperformance for an independent film. Instead, they are assessed relative to production budget, distribution cost, and post theatrical revenue potential. For a film with a mid-range budget, theatrical earning in the low millions can still be considered functional if they contribute to a broader revenue recovery strategy that include digital platform and international scale. It is also worth noting that independent films typically receive a smaller share of ticket revenue that Studio One theater split are counted for. This further reinforces why box office gross alone is not a defective measure of success. What matters more is how theatrical exposure strengthens the film's negotiating position within stream platform and international distributor. In practical terms, the domestic box office performance of Sisu Road to Revenge likely served three main purposes. First, it established the film's presence in the North American marketing, reinforcing brand recognition for the Sisu name. Second, it validated audience interest in the sequel even at a limited scale. Third, it supported the film's long-term value by demonstrating theatrical availability, which remain an important metric in distribution deal for independent films, especially sequel. Maintaining a theatrical footprint is often about continuity rather than expansion. The goal is not exponential growth but sustained relevance. In that sense, the domestic earning of Sisu Road to Revenge suggests sustainability rather than breakout success. The film performed in line with expectation for its category, genre, and release strategy. In conclusion, the domestic box office number of for Sisu Road to Revenge should be interpreted with caution and context. While modest by mainstream standard, they align with the economic realities of independent action filmmaking rather than signaling failure or success in isolation. These earnings represent one major step within our diversified financial model, one where long-term revenue, control cost, and targeted audience matter more than headline figures. Worldwide gross refer to the total theatrical revenue a film earns across all markets, combining domestic box office, typical the United States and Canada, with international box office earning from the rest of the world. The film represents the most comprehensive snapshot of a film's theatrical performance and is widely used within the film industry as a primary benchmark for assessing commercial reach and market penetration. From an industry standpoint, worldwide gross matter because theatrical release and increasingly global by design. Most films, including independent production and finance and distributed with the international audience in mind. As a result, evaluating a film solely on domestic earning provides an incomplete picture. Worldwide gross allows studios, investor, and distributor to determine whether a film resonated beyond a single market and whether its appeal translated across culture and regional boundaries. One key reason worldwide gross is emphasizes risk distribution. Film financing often involve multiple international patron pre-scales and regional distribution agreements. These patrons are less concerned with domestic performance alone and more focused on global revenue potential. A film that perform modestly in one territory but strongly in several others may still be considered commercially valuable. Worldwide gross aggregate these outcomes into a single reference point that reflect overall theatrical demand. Another important factor is scale relative to the budget. Worldwide gross is commonly and compared to production cost to evaluate whether a film has the potential to recover its investment. While this comparison is not a precise profit calculation due to marketing expense, exhibitor cuts and distribution fees, it provides a standardized method for high level assessment. In general industry practice, a film is expected to earn a multiple of its production budget worldwide to be considered financially successful. Though theatrical release alone for independent film, worldwide gross play a different role than it does for major studio blockbusters. Independent production rarely rely on theatrical revenue as their sole primary source of return. Instead, worldwide gross function as a credibility metric, strong or stable global earnings signal to streaming platform broadcasters and secondary distributor that the film has proven audience interest. This can directly influence the value of post-theatrical licensing detail. International performance is especially significant for genre films such as action or thriller titles. These genres often travel more easily across borders because they rely less on dialogue heavy storytelling or culturally specific humor. As a result, a substantial portion of worldwide gross for such films may come from international territories rather than domestic market. Industry analysts therefore examine the balance between domestic and international earning to access a global film global positioning. Worldwide cross may affect long-term brand value for sequel or franchise-oriented films. Consistent global performance support future financing and distribution opportunities. Investors and distributors are more likely to support follow-up projects when prior entries demonstrate reliable worldwide earning, even if those earnings are moderate rather than expansional. In this sense, worldwide growth is not only a retrospective measure but also a forward looking indicator. It is also important to note that worldwide gross reflects theatrical revenue only. It does not include income from digital rental, streaming rights, physical media, or television licensing. However, theatrical performance often set the baseline for this secondary revenue stream. A film with a respectable worldwide gross is generally perceived as low risk when entering negotiations for post theatrical distribution, which can significantly improve its overall financial outcome. From an analytical perspective, worldwide gross matter because its standardized comparison across film of different regions and release strategies. It allow industry professionals to compare performance regardless of where a film was produced or where it earned the majority of its revenue. This make it one of the most commonly cited metric in trade analysis, financial reporting, and performance forecasting. Worldwide gross matter because it captures the full theatrical footprint of a film. It reflects global audience demand, inform budget recovery analysis, sport evaluation in secondary markets, and influence future production decision. While it does not determine profitability on its own, it remains a central data point in industry standard film evaluation logic. Opening weekend box office figures are often treated as an early indicator of a film theatrical performance, but their meaning depend heavily on context. For independent film, opening weekend number function less as a verdict on success or failure and more as a diagnostic tool that help distributor, exhibitor, and investor assess demand, audience targeting, and release strategy effectiveness. Opening weekend earnings represent the revenue generated during the first few days of theatrical release, typically Friday through Sunday. In industry analysis, these numbers are examined not in isolation but alongside factors such as screen count, marketing intensity, release timing, and genre expectation. Without these contextual element, opening weekend figure can be misleading. Screen count refer to the number of theaters or individual screen on which a film is shown during its opening weekend. This figure directly shape box office potential. A film opening on 3,000 screen has a fundamentally different earning capacity than one opening on 300 screen, regardless of audience interest. For this reason, industry professionals often focus on per screen average rather than raw gross totals when evaluating opening weekend performance. Independent film, including mid-budget action titles, are typically released on a limited or semi-wide number of screens. This approach reflects practical constraints such as marketing budget, exhibitor demand, and audience targeting. A controlled screen count allows distributor to manage risk while testing how audience respond in select market before expanding or choosing not to expand the release. When an independent film post modest opening weekend earning on a limited screen count. This is not automatically interpreted as weak performance. Instead, analysts assess whether attendance level align with expectation for that scale of release. A steady per screen average can indicate healthy demand even if total gross figure remain relatively low. Conversely, a wide release with low per screen average may signal overextension rather than success. Opening weekend number also influence exhibitor behavior. Theaters chain use early performance data to decide whether film will retain screen gain additional showtime or be replaced by new release. For independent film, maintaining screen beyond the opening weekend often depend on consistency rather than explosive short starts. Slow but stable performance can result in longer theatrical legs, which is often more valuable than a brief surge. Marketing exposure play a central role in shaping opening weekend result. Major studio film benefit from extensive advertising campaigns that drive urgency and front-loaded attendance. Independent film usually lack this level of visibility, meaning their opening weekends are less concentrated and more reliant on organic discovery. As a result, their box office curve tend to be flatter with smaller opening and steadier decline, or in some cases gradual growth. Release strategy also affect how opening weekend number are interrupted. Some independent films are designed for platform release where they open on a small number of screen and expand gradually based on performance. In such cases, the opening weekend serve primarily as a performance benchmark rather than a revenue peak. Screen count expansion is determined by demand signal rather than predetermined rollout schedules. Another important consideration is genre. Action films often perform better internationally than domestically and may not rely heavily on US opening weekend momentum. For these line, distributor may prioritize global release coordinations over domestic opening impact. As a result, opening weekend number in one territory may represent only a fraction of the film's overall theatrical strategy. From an industry logic standpoint, opening weekend data is most valuable when used comparatively. Analysts compare a film opening to similar title with comparable budget, genre, and release scale. These help determine whether performance align with realistic benchmark rather than inflated expectations set by blockbuster standard. Opening weekend number provide an early snapshot of theatrical performance, but their performance depend largely on screen count and release strategy. For independent film, limited opening and modest totals are inherently negative. What matters is how efficiently a film performs relative to its scale and how well it holds screen, and how opening result sport border distribution and post theatrical opportunities. Opening weekend figure, when interrupted with industry standard logic, are less about spectacle and more about sustainability. The 2x production cost break-even rule is a commonly used industry guidelines for estimated whether a film can recover its investment through theatrical release. It is not a strict counting rule, but rather a practical and shorthand that help analyst, investor, and distributor evaluate financial risk using limited public data. As its simplest, the rule suggests that a film needs to earn approximately twice its reported production budget in worldwide box office gross to reach break even. This multiplier exists because the production budget does not represent the full cost of releasing a film, nor does the studio receive the full amount of box office revenue. One reason the rule exists is the theater revenue split. Cinemas retain a significant portion of ticket sale, often around 50% on average, though the exact percentage varies by territory and by week of release. This means that only about half of the worldwide gross typically returned to the distributor and producer. As a result, a film that grosses the same amount at its production budget would still fall short of covering its cost. Another major factor is marketing and distribution expenses, often referred to as print and advertising. These costs are separate from the production budget and can range from modest amount for independent film to some that rival or exceed the production cost for studio release. Even restrained marketing campaign at substantial expenses that must be recouped before profitability is released. The 2x rule also count for distribution fee and overhead. Distributor usually take a percentage of the revenue they handle, and additional course costs are incurred for legal work, counting, international scale representation, and delivery material. These expenses further reduce the portion of box office incomes that flow back to the filmmaker or investor. It is important to understand that the rule is a generalized average, not a precise calculation. Some film may break even at less than twice their production budget if marketing costs are low, if international revenue split are favorable, or if pre-scale and tax incentives significantly offset expenses. Other may require more than double their production cost if marketing spending is high, or if revenue split are less favorable. For independent film, the rule is often used as a high level benchmark rather than a defective threshold. Independent financing structure frequently include pre-sold international rights, public funding, or tax rebates that reduce the amount of money that must be recovered through box office alone. In such cases, theoretical revenue is only one part of larger financial model. Another limitation of the 2x rule is that it applies only to theatrical performance. It does not consider income from streaming, license, video on demand, scale, television rights, or physical media. This secondary revenue stream can substantially change the final financial outcome, particularly for film with strong niche appeal or long tail value. Industry professionals continue to reference the 2x rule because it provides a simple, standardized way to compare film across different budget and markets using publicly available data. It allows quick assessment without access to confidential contracts or detailed profit participation agreement. The 2x production cost break even rule exists to reflect the combined effect of theater split, marketing expense, and distribution cost. It serves as a rough analytical tool for understanding financial recovery at the budget. Theoretically requires separating perception from counting reality. Theoretical recovery refers specifically to whether the box office revenue return enough money to offset production cost after standard industry deductions, not whether the film eventually became profitable through all revenue stream. The reported production budget for Sisu Road to Revenue Revenge is in the low to mid 8-figure range, placing it within the mid budget category for independent or internationally financed action film. Using this figure as a baseline, the question becomes whether worldwide theoretical earnings reach the threshold typically associated with the break even performance. Industry analysis commonly apply the 2x production cost guideline when evaluating theoretical recovery. These guidelines reflect the combined effect of exhibitor revenue split, marketing expense, and distribution fee. Under this logic, a film within a production budget is in this range would generally need to earn roughly twice its production cost in worldwide box office gross to recover its investment through theatrical exhibition alone. Available box office reporting indicate that the film worldwide theatrical gross fell below that benchmark, while the movie did earn revenue across domestic and international market. the combined total did not reach the level typically required for full theoretical cost recovery under standard revenue sharing condition. This suggests that theoretical income alone was significant to fully offset production cost. It is important to clarify what this conclusion does and does not mean. Failing to recover a production budget theoretically does not imply financial failure. Many independent films are not structured to rely excessively on box office revenue for cost recovery. Instead, theatrical release often function as one component within a broader revenue framework. In the case of Sisu Road to Revenge, the theatrical run appeared to have been strategic rather than exhaustive. The film was released on a controlled number of screens, supported by a restrained market and targeted toward a specific audience segment. These choices limit theatrical upside but also constrain expenses, reducing financial exposure. Another factor affecting theatrical recovery is revenue retention. Only a portion of box office gross returned to the distributor and producer, with theaters retaining a significant share. International market often return even less favorable split than domestic one. As a result, even moderate worldwide gross can translate into relatively modest net return at the production level. Marketing costs also play a role. While independent film typically spend less on promotion than studio release, marketing and distribution expenses still add to the total amount that must be recovered. These costs are not included in the production budget but are essential for theatrical release, further raising the effective break-even point. From a purely theoretical accounting perspective, the conclusion is therefore straightforward. A film did not recover its production budget through box office revenue alone. This outcome aligns with common pattern for mid-budget independent action film, particularly those without wide release or major studio backing. Theoretical recovery is only one dimension of financial performance. Independent film often rely heavily on post-theatrical revenue stream, including digital rental, streaming license, television rights, and international distribution agreement. In many cases, these revenue sources contribute more significantly to overall cost recovery than theatrical exhibition. Additionally, pre-scale tax incentives and institutional funding can reduce the amount of capital that need to be reopened from box office performance. These factors are typically not reflected in public reporting, making it difficult to determine total financial outcome based on theoretical data alone. When evaluated strictly through an industry standard theoretical lens, Sisu Road to Revenge did not recover its production budget via box office earning. This assessment is based on standard revenue split, typically marketing cost, and widely used break-even logic. It represents a financial classification, not a qualitative judgment, and does not count for the film full revenue life cycle beyond theaters. In industry term, underperformance is a descriptive financial label used to indicate that a film did not determine predefined commercial benchmark established before its release. It is not an emotional judgment about quality, effort, or audience enjoyment, and it does not imply failure in absolute sense. Instead, it reflects a gap between projected and release financial outcome within a specific revenue window. At its core, underperformance refers to a situation where a film's earnings fall below internal expectation based on factors such as production budget, marketing spend, release scale, and historical comparison. These expectations are typically set by distributors, financiers, and exhibitors using comparable titles and market conditions. The benchmark differ widely depending on whether a film is a studio blockbuster, a mid-budget release, or an independent production. In theoretical terms, underperformance often relate to box office result relative to cost. If a film does not generate enough theoretical revenue to approach or meet its anticipated break-even threshold. It may be described as underperforming in that channel. This assessment usually incorporates standard revenue split, distribution fee, and marketing expense, not just raw gross totals. Another common use of the term involves opening weekend performance. If early box office figures fall significantly below projection for a given screen count and marketing level, the film may be labeled an underperformer in opening analysis. This does not count for long-term revenue but serves as an early indicator for exhibitor and distributor making short-term scheduling decisions. Underperformance can also be defined relatively to similar film. Industry analysts frequently compare a release to recent title with comparable budget, genre, release strategy, and target audience. If a film earns less than established range for its peer group, it may be categorized or underperforming even if its absolute earnings are not significant. Importantly, underperformance is context specific. A box office total that would be acceptable for a limited independent release would be considered underperformance for a wide studio release with higher cost. The term always depend on scale, expectation, and intended market reach. The industry also distinguishes between theoretical underperformance and overall financial outcome. A film may underperform theoretically but still achieve cost recovery or profitability through non-theoretical revenue streams such as stream licensing, television scales, or international distribution deal. In such cases, underperformance apply only to one segment of the revenue model. Underperformance is also used in reporting and forecasting, not final counting. Early assessment may change as additional revenue is released over time. For this reason, the term is often provisional and subject to revision. Underperformance in industry term means that a film did not meet expected financial benchmark within a defined context. Most commonly, theoretical revenue is a neutral analytical classification based on projection and comparison, not a statement about artistic merit or long-term value. Estimating ticket scale from box office number is a standard analytical practice in the film industry used to translate revenue figure into audience scale. Because box office revenue is reported in monetary term rather than audience figure, analysts rely on estimate to understand how many people actually saw a film in theater. This approach provides insight that raw gross number alone can't offer. The basic method for estimating ticket scale involves dividing total box office gross for the average ticket price is the relevant market. For example, if a film earns $10 million domestically and average ticket price is approximately $10, analysis refer that roughly 1 million tickets were sold. This calculation is not exact, but it offers reasonable approximation that allow for comparative analysis across film and time periods. Average ticket price is a key variable in this process. Ticket price vary by region, theater type, format, and time of day. Premium formats such as IMAX or 3D increase the average price, while matinees, showing, and discount day reduce it. Analysts typically use national or regional average published by industry bodies to smooth out these variations. While this introduce some margin of error, it allows for consistency in comparison. What reason analysts estimate ticket sales to contextualized box office performance. A film that earned $15 million during one period may have sold fewer tickets than a film that earned $10 million in an earlier era when the ticket price were lower. Without attendance estimate, comparison across years can be misleading. Ticket sale estimate help normalize performance over time and provide a clear picture of audience reach. Estimating attendance is also useful for evaluating audience engagement. Revenue alone does not indicate how many individuals will reach. A higher gross could reflect high ticket price rather than higher turnout. By estimating tickets sale, analysts can assess whether a film attracted a large number of viewers or rely on a smaller audience paying higher prices. This distinction matter when evaluating a film's culture footprint and market penetration. And the other reason analysts use ticket sale estimate is to assess release strategy effectiveness. When combined with screen count data, estimated audience can be translated into pre-screen attendance average. This helps determine how efficiently a film performs in the theater where it plays. Strong per screen attendance suggests concentrated demand, while lower average may indicate weaker audience pool or overexposure. Ticket sale estimate are also valuable in comparative genre analysis. Action, family, and horror film often perform differently in terms of attendance versus revenue. Family films may sell more tickets due to group attendance. While understand these patterns and compare film within and cross genre more accurately for a financial perspective, attendance estimate help inform downstream revenue expectations. Streaming platform, television network, and advertiser are interested in audience size, not just theoretical revenue. A film that sold sell 1 million tickets theoretically may be viewed as having stronger brand awareness and audience familiarity, even if its box office gross was moderate. This can influence licensing, evaluation, and distribution negotiations. Analysts also estimate ticket sale to support international comparison. Different countries have widely varying ticket price. A film may earn less revenue in one market but sell more tickets than in another. Attendance estimate allow analysts to compare audience interest across territories without distortion from price differences. It is important to note that ticket sale estimate are approximations, not official count. Most territories do not publicly report attendance figure, and even when they do, reporting standards vary. Analysts therefore prioritize consistency over precision, using standardized assumption to enable comparison rather than claiming exact totals. The practice also helps separate economic performance from audience behavior. A film may underperform financially due to limited release, poor timing, or high cost, yet still reach a substantial number of viewers. Estimated ticket sale reveal this distinction by focusing on how many people choose to see the film, independent of pricing and cost structures. In summary, analysts estimate ticket sale to convert box office revenue into a more intuitive measure of audience size. This practice allows for meaningful comparison across time, market, and genre, support evaluation of release strategy, and inform broader assessment of audience reach. While imperfect, ticket sale estimation remain a useful analytical tool because it shifts the focus from money loan to participation, which is central to understanding theatrical performance. Connecting box office performance to audience reach rather than quality is a standard analytical approach in film industry evaluation. Box of office data measure how many people were exposed to a film in theaters and how widely it circulated, not how well it was made and how it was received on an artistic level. Understanding this distinction is essential for accurate financial and marketing analysis. At its core, box office performance reflect market access and participation. It shows how many viewers choose to be a ticket during a specific release window, given the film's availability, market visibility, pricing, and competition. Um, the factors shape audience reach long before question of quality enter the equation. A well-made film can have limited reach due to constrained distribution, while a widely released film can reach millions regardless of reception. Screen count is one of the primarily driver of audience reach. A film shown thousands of screen has fewer more opportunity to be seen than one playing in a few hundred theater. Box office performance therefore sales with exposure higher grosses often indicate broader access rather than stronger approval. For this reason, analysis frequently normalize box office figure by screen count or use per screen average to separate reach from demand. Marketing intensity further influence reach. Advertising increase awareness and urgency, expanding the pool of potential viewer. Film within limited marketing may rely on organic discovery, which grow more slowly and result in lower initial box office total. This dynamic has little to do with quality and much to do with visibility. Box office number capture the outcome of that visibility, not an evaluation of the content itself. Release timing also affect audience reach. Film released during crowded period compete for attention and screen, which can cap their box office performance even if interest exists. Conversely, release during quieter period may benefit from reduced competition and achieve higher gross relative to their scale. These variations illustrate why box office performance reflects situational reach rather than inherited merit. Audience segmentation play a role as well. Some films are designed for broad demographic, while other target narrower group. A film aim at a specific audience may achieve strong engagement within that group but still produce modest box office total due to limited overall reach. Box office figure reflect the size of the reachable audience, not the intensity of engagement among those who attend. Box office performance is also shaped by geographic reach. Worldwide gross aggregate attendance across multiple territories, each with different ticket price, culture, performance, and distribution capacities. A film may have strong reach in certain region and minimal presence in other. The combined total represent cumulative exposure, not uniform reception. From an industry perspective, box office numbers are therefore used to estimate how many people are a film reached, theoretically not how well those people responded. Analysts often convert revenue into estimated ticket sale to approximate attendance. This reinforces the idea that box office is fundamentally about participation. Whether viewers like the film, dislike it, or felt neutral is outside the scope of the box office measurement. The distinction is practically important when discussing underperformance. A film described as underperforming at the box office is not being labeled as low quality. Instead, the term indicates that the film did not reach as many viewers as projected under given release conditions. The gap is between expected and actual reach, not between good and bad filmmaking. The separation of each and quality being reach and quality becomes even clearer when considering post-theatrical life. Many films with a limited box office reach later find larger audience through streaming, television, or home media. Their theatrical box office reflect constraint assessed during release, not their long-term audience impact. Industry professionals account for this by treating box office as an early distribution metric rather than a final verdict. Critically, quality is measured through different instrument reviews, audience score, award recognition, and long-term culture presence. These metrics operate independently of box office data, while correlations sometimes exist that they are not causal. Box office success does not prove quality, and limited box office does not disprove it. Box office performance is best understood as a measure of audience reach under specific market condition. It indicates how widely a film was seen in theaters, shaped by screen marketing, timing, and access. Interpreting box office number in this way avoid conflating financial outcome with artistic evaluation and aligned with standard industry analysis practice. Box office performance play a significant role in shaping perception around a film, even though it does not describe the film itself. In industry and public discourse, box office number often function as a proxy for visibility, relevance, and momentum. These influence operate at multiple levels, affecting how a film is discussed, positioned, and remembered independent of its content or quality. One primarily way box office performance affect perception is through media framing. Film with strong box office results are frequently described using terms such as hit, success, or breakout, while lower grossing film may be labeled underperformance. These labels simplify complex financial outcome into easily digestible narratives. Over time, repetition of such language shape public understanding, even when the financial context is more nuanced than the headline suggests. Box office number also influence industry confidence signal. Distributor, exhibitor, and financier rely on performance data to assess market demand. A film that performs well theoretically perceived as having validated audience interest, which can affect how future projects associated with the same creators or intellectual property are viewed. Conversely, modest box office result can lead to more caution positioning even if the film reaches its intended audience effectively. Public perception is further shaped by comparative visibility. Box office ranking, weekend charts, and cumulative gross list create hierarchies that imply relative importance. Films appearing near the top of these lists receive more attention, discussion, and culture presence. Those lower on the chart may be overlooked regardless of audience satisfaction and critical response. In this way, box office performance are influenced when what inter mainstream conservation. The relationship between box office and perception is also tied to expectation setting before release. Projection and forecast establish anticipated performance level. If a film exceeds these expectations, it is perceived as a outperforming, which often generate positive narratives around momentum and audience appeal. If it falls short, perception may shift toward disappointment even when absolute performance remain reasonable. Within a broader context, box office performance also affect longevity of attention. Film with strong theatrical run tend to remain visible longer, receiving extended media coverage and continued theatrical support. This sustained exposure reinforce a perception of relevance. Film with weaker box office run often experience a faster decline in attention, which can limit public awareness and discussion regardless of later success in other distribution channel. Another factor is institutional perception, and award bodies, festival, and industry organization may not officially consider box office result when evaluating merits, but commercial performance can still influence which film receive promotional backing or sustain campaigns. Box office success can signal that a film has penetrated public consciousness, making it easier to justify continued investment in visibility. Important box office performance shape perception without conveying audience sentiment. Ticket sale indicate how many people attended, not what they thought forward. However, in public discourse, high attendance is often implicitly associated with approval, while low attendance is sometimes interpreted as rejection. This assumption persists despite the lack of direction correlation between reach and reception. The effect of box office on perception is especially pronounced in an era of data driven storytelling. Numerical performance offer a clear, seemingly objective metric that can be easily communicated. This simplicity gives box office figure disproportionate influence in shaping narrative, even though they capture only one aspect of a film's interaction with audience. It is also worth noting that perception influenced by box office performance can evolve over time. Films initially perceived as minor release due to limited box office exposure may later be reassessed as their audience grow through non-theatrical channels. However, the initial perception created by theatrical performance often leave a lasting imprint. In summary, box office performance affect how a film is perceived by shaping narratives around visibility, relevance, and momentum. It influences media framing, industry confidence, and public attention without describing the film content or quality. Understanding this distinction allows box office data to be interpreted as a measure of exposure and positioning rather than as an evaluation of the films itself. Some films succeed artistically despite how earning because artistic impact and commercial performance may get different outcome in industry and culture term. Box office revenue reflect reach and access during a specific release window, while artistic success reflect expression, resonance, and lasting influence. These two measures often diverge specifically outside the mainstream studio system. One key reason is a limited distribution. Many artistically ambitious films are released on a small number of screens or in select territories. These limit their earning potential regardless of audience response. A film can deeply affect viewers and critics yet remain financially modest simply because it was not widely available during its theatrical run. Another factor is targeted audience scope. Some films are designed for specific or unconventional audience rather than mass appeal. Experimental narrative, restrained pacing, or culturally specific themes may resonate strongly with a narrow group while remaining inaccessible to broader market. Artistic success in these cases is measured by depth of engagement rather than volume of attendance. Marketing constraints also play a role. Independent and art-focused films typically operate with minimal promotional budget. Without extensive advertising, even high quality work may struggle to attract attention during release. Artistic recognition often develops later through festivals, critical discourse, and word of mouth rather than immediate box office result. Release timing can further limit earnings. Film release alongside major commercial titles may be overshadowed regardless of merit. In such cases, how low learning reflect a competitive condition rather than lack of artistic value. Artistic evaluation, which occur over longer period, is less sensitive to these timing pressure. Creative priorities also influence outcome. Films that prioritize one theme or experimentation over accessibility may sacrifice commercial appeal by design. These choices can result in lower attendance while strengthening the film's artistic identity. In industry terms, this represents a trade-off between reach and expression rather than a failure of execution. Another reason is the difference between immediate consumption and long-term recognition. Artistic success often unfold over time. Some films gain influence through academic study, critical re-evaluation, or inspiration of later creators. Box office performance capture a brief moment, while artistic success can emerge gradually and persist for decades. Critical reception and peer recognition operate independently of earning award festival selections, and critical acclaim assess craftsmanship, originality, and thematic depth rather than market performance. Films that perform modestly at the box office may still be regarded as important work within their genre or medium. Culture and regional specificity also affect earning without diminishing artistic value. Films deeply rooted in particular language, histories, or social contexts may struggle commercially in global market but remain artistically significant within their culture framework. Artistic success in these cases is measured by authenticity and representation rather than financial return. Finally, audience behavior itself contribute to this divergence. Not all viewers prioritize theatrical attendance. Some artistically successful films reach their audience primarily through home viewing, streaming, or academic setting. Their impact becomes evident outside the box office system altogether. Films can succeed artistically despite low learning because artistic achievement is not dependent on scale or revenue. Limited access, targeting audience, and creative risk and long-term influence all contribute to a form of success that box office numbers are not designed to capture. Cinema score and audience rating are commonly referenced alongside box office data, but they serve a different analytical function. In financial terms, these metrics do not measure revenue differently. Instead, they help people explain audience reaction after purchase and how that reaction may influence a film's commercial strategy beyond its opening weekend. Cinema score is collected through in theater polling on opening night, capturing response from viewers who choose to see the films immediately upon release. Because of this timing, cinema score reflect the sentiment of the film score opening audience, not the general public. From a financial standpoint, this make it a diagnostic tool rather than predators of total earning. The primarily financial value of cinema score lie in its relationship to box office sustainability. While opening weekend performance is driven largely by marketing, brand awareness, and pre-release expectation, subsequent weekends are more influenced by word of mouth. A strong cinema score suggests that early audience respond in line with or above their expectation, increasing the likelihood of repeat audience and slower week to week decline. Conversely, a longer cinema score indicate a mismatch between expectations and experience in financial terms. This often correlates with front loaded box office behavior, where our films earn a strong proportion of its total gross in the opening weekend and then decline rapidly. This pattern affects theoretically longevity rather than total opening revenue. Audience rating on platform outside theaters function differently. These ratings accumulate over time and reflect a broader segment of viewers, including those who did not attend opening weekend. Financially, this data become more broader segment for of viewers. Those who did not attend opening weekend financially, this data become more relevant after theatrical release. When film enter digital streaming and home media markets, strong audience rating can support sustained revenue in the secondary window, even if theatrical performance was limited. From an industry logic perspective, cinema score is more influential for exhibitor. Theaters chains use early audience reaction as one factor while deciding whether to retain screen, reduce short time, or allocate space to competing release. A film with steady audience reception is more likely to maintain screen presence, which can modestly extend theatrical revenue. Distributors, on the other hand, view audience rating as part of risk assessment for downstream monetization. Streaming platform and television buyers evaluate audience reception to estimate engagement potential. Film with moderate box office performance but strong audience response may still be viewed as a reliable licensing assessed because it suggests viewer satisfaction rather than rejection. It is important to note that cinema score and audience rating do not significantly affect opening weekend revenue. It is important to note that cinema score and audience rating do not significantly affect opening weekend revenue. It is important to note that cinema score and audience rating do not significantly affect opening weekend revenue, which is largely predetermined by marketing reach and distribution scale. Their influence emerge forward, shaping the slope of the box office curve rather than its starting point. In financial analysis, this distinction matters because it clarifies that strong audience score can't compensate for limited exposure but can enhance efficiency within that exposure. Another key consideration is audience composition. Cinema score reflect buyers who were motivated enough to attend earlier. For niche or genre film, this group may already be aligned with the film style and intent. As a result, cinema score for such film should be interpreted relevant to genre norms rather than mass market expectations. Financial analysts suggest for this when comparing titles across different audience profile, audience rating also influence long-term brand value while not directly monetize. Positive reception can improve the market perception of filmmaker, actor, or intellectual property, which may affect financing term for future project. This impact is indirect and cumulative rather than immediate. Importantly, neither cinema score nor audience rating measure reach. They indicate reaction among those who attend, not how many people attend. Financially, this means they explain how well the film satisfied its audience, not how large that audience was. Box office figure and rating therefore answer different questions and must be analyzed together, not interchangeably. In summary, cinema score and audience rating function as sustainability indicator both in the financial life cycle of a film. They help explain box office trend after opening weekend, inform exhibitor and distributor decision, and influence downstream revenue potential. They do not determine earning on their own, but they provide context for how effectively a film convert attendance into sustained commercial values. Comparing critical reception with box office outcome require treating them as two separate measurement systems that operate on different timeline and answer different questions. Industry analysis critics evaluate film based on craft, coherence, originality, and execution, while box office outcome measure how many people attend did under specific market condition. Because these systems serve different purpose, alignment between them is not assumed. Critical reception reflect professional assessment rather than market response. Reviews are typically published before or during release and influence perception among media, cinephiles, and award bodies. However, their direct impact on ticket sales is limited, specifically for films without wide distribution or major marketing support. A strong critical response can raise visibility, but it does not automatically translate into higher audience. Box office outcome, by contrast, reflect consumer behavior at the point of purchase. It is shaped by assesses awareness, timing, precising competition, and brand familiarity. These factors often outweigh critical opinion in determining whether audience attend. Theoretically, as a result, a film can receive favorable reviews yet generate modest box office revenue if its release scale is limited. In industry term, this divergence is common among independent and mid-budget film. Critics may respond positively to elements such as direction, tone, or thematic clarity, while the film theoretical reach remain constrained. In these cases, box office outcome reflect structural limit rather than audience rejection. The film did not fail to connect with viewers; it simply reached fewer of them. Conversely, film with mixed or weak critical reception can achieve strong box office outcome if they benefit from wide release, recognizable intellectual property, or extensive marketing. This illustrates that box office success does not require critical approval. It requires awareness, availability, and perceived immediacy. Critical reception may influence long-term reputation, but it is not a prerequisite for commercial reach. Another important distinction lies in timing. Box office outcomes are front-loaded and concentrated within a short theoretical window, while critical reception has a longer lifespan. Reviews continue to shape discourse well after theoretical release, influencing academic discussion, festival programming, and retrospective evaluation. Box office performance once recorded does not evolve in the same way. From a financial perspective, creative scores are more closely linked to box office sustainability than to opening size film. With stronger critical reception, often experience steadier decline, better word of mouth, and longer theoretical legs when distribution allow. However, if screen count is limited, this stability does not result in high total. The relationship exists, but it is conditional. The comparison between critical reception and box office outcome becomes especially relevant when discussing perceived success. A film with strong reviews and modest earning may be described as critically successful but commercially limited. This framing acknowledges that the film met artistic benchmark while operating within constrained market conditions. Industry professionals routinely make this distinction. It is also important to note that critical reception influences non-theoretical evaluation more than box office total due. Streaming platform, broadcasters, and culture institutions consider reviews when assessing long-term relevance and engagement potential. In these sense, critical reception may compensate for limited box office exposure by supporting extending life beyond theaters. In practical terms, critics and box office answer different strategic questions. Critical reception asks whether the film achieves its creative objective. Box office outcome asks how widely the film was seen during release, and when these measures diverge, the divergence highlight difference in distribution scale, audience targeting, and market condition rather than a contraindication. In summary, comparing critical reception with box office outcome reveal that they measure distant dimension of performance. Critical reception evaluate artistic execution and impact, while box office outcome measure audience reach under specific circumstances. Alignment between the two is possible but not required. Industry analysis react them as complementary data point rather than competing verdicts, recognizing that the film cultural and financial trajectories often follow different paths. The critical lifespan of a film refer to the length of time it remain in cinemas and continue to generate box office. In industry analysis, theoretical lifespan is an important factor because it influences not only total box office earning but also downstream revenue potential. Opening weekend performance often attract the most attention. The duration of film theatrical run play a significant role in determining its overall financial outcome. A longer theatrical lifespan allow a film to accumulate revenue gradually. Even if opening weekend number are modest, sustained attendance over several weeks can meaningfully increase total gross. This pattern is especially relevant for films that rely on word of mouth rather than large marketing campaigns. In such cases, revenue is spread over time rather than concentrated at the start. Theoretical lifespan is closely linked to exhibitor decision. Theaters operators regularly evaluate attendance, pre-screen averages, and audience response when deciding whether to retain a film on the screen. Films that demonstrate stable performance are more likely to hold screen, while those with sharp decline are removed more quickly. This feedback loop directly affects how long a film remains available to audience. Screen count over time also matter. A film may align with a limited release and gradually expand if demand is sustained. Alternatively, it may open wide and then contract rapidly, but both scenarios affect total revenue differently. Expansion allow a film to reach new audience over time, while contraction limits additional earning potential. Theoretical lifespan encompasses not just duration but also the pattern of screen allocation throughout the time. From a revenue perspective, later we contribute a smaller share of total gross on a per week basis, but they can still be meaningful in aggregate. For film with lower production and marketing costs, these incremental uh, earning may represent a substantial portion of total theatrical revenue. In contrast, film with a short lifespan often rely heavily on their opening weekend, increasing financial volatility. Theoretical lifespan also affect revenue timing, which has implication for cash flow. A revenue earned over a longer period arrive more gradually, but it can reduce dependence on a single performance window. For independence film, this can improve financial stability by spreading return rather than concentrating them into a brief peak. Another important consideration is the relationship between theoretical lifespan and the more post-theoretical revenue. A longer run can enhance the film visibility and perceive legitimacy, which may improve performance in digital rental, streaming license, and television scale. Theoretical presence function as a form of validation that can influence negotiation in secondary market. It is also worth noting that theoretical lifespan interact with audience behavior. Some viewers delay audience due to scheduling, awareness, or pricing consideration. A longer run increase the likelihood that their viewers will have an opportunity to see the film theatrically. Short term, by contrast, limit access and potential reach reduce potential reach. For genre and independent film, theatrical lifespan is more often important than peak performance. These films may never achieve high signal weak crosses, but sustain availability allow them to maximize the audience that is willing to seek them out. In such cases, total revenue reflect per resistance rather than intensity. Theoretical lifespan impact total revenue by determining how long a film remain available to earn money and how broadly it can reach audience over time. Longer lifespan support gradual revenue accumulation, improve visibility, and strengthen downstream revenue potential. While opening performance set initial condition, it is the duration and stability of a film's theatrical run that often shape its final financial outcome. As a reviewer looking back at the entire experience, this movie feels like a deliberate statement rather than a simple piece of entertainment. It does not chase approval or try to satisfy every type of viewers. Instead, it comments fully to its tone and vision, even when that choice risks alienating part of the audience. That confidence is one of the strongest qualities. From beginning to end, it feels controlled, purposeful, and emotionally grounded. What stands out most is how much the film trusts the audience. It does not rush to explain its character or spell out its theme. It allows silence, stillness, and atmosphere to carry meaning. This approach requires patience, but it also creates a deeper connection for viewers willing to engage on that level. As a reviewer, this restraint feels refreshing in a landscape where many films rely on constant stimulation. The performance deserves special recognition. The lead performance carries enormous weight with minimal dialogue, relying on physical presence and emotional restraint. This kind of acting is difficult, and here it is handled with precision. Sporting performances are equally disciplined. No one overreacts or break the tone. Together, the cast create a believable world where emotion is expressed quietly but clearly. Visually, the film is confident and consistent. Cinematography, lighting, and framing work together to reinforce the emotional state of the story. Nothing feels accidental. The environment feels rushed and unforgiving, mirroring the inner lives of the characters. Sound design particularly elevates the experience. The choice to use silence as a tool is risky, but pays off by increasing tension and emotional immersion. That said, the film is not without flaws. Pacing with will remain the biggest challenge for many viewers. Many scenes linger longer than necessary, and the story demands more patience than most action films. For casual audience, this can longer than necessary. This can feel slow or unevenful. The lack of dialogue and limited backstory may also create emotional distance for many viewers. These are not mistakes, but they are conscious trade-offs that will not work for everyone. From a critical standpoint, the movie succeeds because it knows exactly what it wants to be. It does not compromise its identity to chase popularity. While it may not reach a wide audience, it connects deeply with the right one. Over time, this kind of clarity often leads to stronger long-term appreciation rather than short-lived success. In the broader context of modern cinema, the film represents an important reminder. Action does not need to be loud to be powerful. Stories do not need constant explanation to be meaningful. By focusing on consequence, endurance, and emotional weight, the film offers an alternative path for the genre. In my final assessment, this is a movie that grows with time. It may challenge expectation on first viewing, but it reward reflection and rewatching. It is not designed to entertain everyone, but it is designed with care, honesty, and purpose. For viewers open to a slower, more thoughtful experience, it stands as a strong and memorable piece of filmmaking that lingers long after the final scene fade. This movie is best understood when expectations are clear. It is not made for everyone, and that is one of its defining qualities. Knowing who it speaks to can greatly shape the viewing experience, turning potential disappointment into appreciation. This movie should be watched by viewers who enjoy slow atmospheric storytelling. If you like films that take their time, build tension quietly, and focus more on mood than constant action, this experience will likely work for you. It is specially suited for people who appreciate visual storytelling and subtitle performance, those who enjoy reading emotion through silence, body language, and small detail will find a lot to engage with. Other fans of grounded action will also connect strongly. The violence is not exaggerated or flashy, it feels physical, tiring, and consequential. If you prefer realism over spectacle and action that feel heavy rather than entertaining, this movie aligns with that taste. Viewers who appreciate discipline, restraint, and emotional weight in action cinema will likely respect the approach even if they find it challenging. The film is also a good choice for viewers who enjoy character driven stories. The focus is not on complex plot twists or fast moving stories but on internal conflict and personal transformation. If you enjoy watching a character change slowly through experience rather than explanation, the journey here feels meaningful. It rewards patience and attention. On the other hand, this movie may not be suitable for viewers looking for fast paced entertainment. If you prefer constant movement, frequent dialogue, and clear explanation, this movie may feel slow or empty. It does not rush to deliver payoff, and it often sit in silence. For viewers who watch movies mainly for excitement or background entertainment, this experience may feel demanding rather than enjoyable. It may also not work well for those expecting a traditional action structure. There are no heroic speeches, no clear emotional release, and no specific moral victories. If you enjoy clear good versus evil storytelling or dramatic emotional moments spelled out through dialogue, the restrained style here may feel distant or unsatisfying. Casual viewers or those unfamiliar with slower cinema style may struggle as well. This movie asks for attention and emotional involvement. Watching it while distracted, multitasking, or expecting quick reward may reduce its impact. It is better experience in a focused setting where atmosphere can be felt fully. Younger viewers or audience seeking light entertainment may also find it heavy. The tone is serious, the themes are dark, and the emotional weight is constant. It is not designed to be fun or comforting. Instead, it asks the viewers to sit with discomfort and reflect on consequence. In the end, this movie is ideal for viewers who are open to being challenged rather than entertained in the usual way. It suits those who enjoy cinema as an emotional and artistic experience, not just a source of excitement. For the right audience, it can be powerful and memorable. For others, it may feel slow, quiet, or emotionally distant. Understanding that difference is key to deciding whether this journey is one worth taking.